You want to jump right into your deal?
Yeah. So this is our team. So we have various people. Most of the people on the team I met through the Jake and Gino community. So myself, Nick DiLeone, I have twin 5-year-old sons. My wife is Korean, so I can speak a little bit of Korean. I live with my mother-in-law who's Korean. She doesn't speak a lot of English, so it's kind of good. She can't nag me, or when she nags me, I really don't understand what she's saying. Yeah, it's pretty good.
I screwed up.
So love that. Love grandma and with the kids. My partner Mike Prowl, he's house hacked 3 properties in 3 different states: New Mexico, Tennessee, and I'm not sure what the last one is. And he's an avid surfer. Marshall Friedman, he's part of the Jake and Gino community. I met Marshall at an event in Atlanta, a Jake and Gino event right before COVID hit in January of 2020. And we connected. He lived in New York for a little while. I did as well. He's fluent at Mandarin, and he's a Duke and UNC sports fan, which is pretty atypical. Usually they don't like each other. That's why he put that on there. And my last partner, Keddy, met him in San Francisco. He was part of, he's cut out here, but he's in a picture here with Vinny Chopra at the San Francisco Multifamily and More meetup. So I met him that way through Hendra and Mercy, who head up that meetup. And Keddy is also part of the Jake and Gino community, but he works at Google full-time as a W-2 employee, and his job is to hack Google's programs. So he's a professional hacker, basically.
What I love about this, Nick, is the quality of the community that we have. I mean, you're in commercial real estate and underwriting. Marshall Friedman was an investment banker in New York who left, and Keddy is working for Google. And I mean, it's just amazing the quality of people that we have in the community that you're able to, be able to network, be able to partner up with, be able to utilize their skill sets. And I think, if I'm not mistaken, that's probably one of the main reasons that propelled you to be able to close 5 deals in this last year, to be able to plug and play your skill sets with everyone else's skill sets, and to be able to actually move into the market and take that leap of faith was also one of the things that I think propelled you as well.
No, that's exactly right. I mean, this is kind of the next slide. This is exactly it. I mean, my limiting belief going in, being in commercial real estate for a long time, I could do it myself. I'll buy properties on my own. I could figure it out myself. And really, it was it was the community. It was definitely the mindset of the community. Like, real estate is a team sport. But my wife is a New Yorker. She's very blunt, kind of punch you in the face, give you the truth. And she's like, stop, get rid of the ego, right? Get rid of the ego, and reach out to people and fill your weaknesses with other people's strengths.
That's so
right?
hard though.
Yeah,
I struggle with that. It's way easier said than done, and it's amazing that you have a support partner that's helping you with that. Because I personally struggle with that bad, and just not wanting to network, thinking you know it all. Especially when I started, I was like, but I got the G Daddy, so he kind of helped me out here. But dude, I feel you on that one hard.
I still feel it. I mean, she was telling me today, like, stop, get rid of the ego. You don't know it all. She's still doing that, but it is good to have that support. Best bet, this bullet point here, Jake, you talk about the I'm mentality, like, I'm going to do everything, right? I'm going to call up the vendors. I'm going to do everything myself. And like, you really need to delegate, and you really need to fill the spots where you're weak, right? Mm-hmm. So my background was asset management. I had a little bit of underwriting, but my underwriting was kind of my weak spot. And that's where the Jake and Gino community, the education came in with Bill Ham, Marshall and Keddy. Keddy has that, really technical background. Marshall was underwriting deals for investment banking firms. Mike Prowl, who's not part of the community, but he was a Citibank underwriter for multifamily. Mm-hmm. So a lot of underwriting experience on the team. My background was more operations. So just through the community, all the deals that I've done, 6 deals last year. Most of the partners are through the Jake and Gino community. Mm-hmm. And again, filling those gaps where, I have blind spots. Mm-hmm. So this is the deal. It's a 120 unit deal in Waco, Texas. You can see in the picture here, it's flat roof. I know generally Jake and Gino they want pitch roof. They don't like flat roof.
Hey man, we got some. All right. I'm not trying to say that we don't. We got some in the portfolio. So we understand.
I mean, they can be a pain. My last W-2 was industrial, right? So I was used to dealing with flat roofs. And I knew if I got in that roof with my guy from my last W-2 job, the roof guy, We had a national contract with that guy. He would give me the straight poop on the roof, and it was in good shape. It was a TPO roof. It was in good shape. So we knew that was an issue, but we thought that would probably thin the buyer pool a little bit, which it did. A lot of people kind of stay away from flat roof. The other thing, my wife really kind of pushed, like Dallas, Fort Worth, that's where I'm based, super competitive, tons of capital coming into that market. So it's hard to find a deal, and we didn't get our first deal into 2021. It took us a year. So that was another pivot we made. Let's look at, tertiary markets, secondary markets in Texas. So Waco was a little bit less competitive. Flat roof made it a little less competitive. And it allowed us to get this deal.
Nick, when was the epiphany moment when you saw this deal and you said, this is the deal? Did you have your buy right criteria created? Did you have, whether it was median income, whether it was number of units, whether it was age of the asset, unit mix? When did you know that this was the deal for you?
Yeah, I mean, we looked into it and we underwrote it. We were one of the first teams to look at it. We like the fact that it was 70s, not 60s, because you have more plumbing in that space. The household income was very, very good. One thing we found out, and it's going to come up later, is that this is in a better school district than a competitive property right across the street. So a lot of families wanted to come and live at this property because the school district is much better than the Waco ISD. Mm-hmm. So really it was very early on that we knew that this was a good property. And I'll kind of get into it here. Through looking at the deal, one thing that we noticed was that most of the units were already renovated, and there was actually one syndicator. He's based in Austin. He quickly looked at this deal and kind of brushed it aside because he said he wanted a deep value add deal. Mm-hmm. And that's the reason why we like this deal. It actually turned out to be a management play. There was another syndicator, part of a big education group based here in Dallas, and he renovated most of the units. So it was really just kind of a layup for us to raise rents and reduce expenses. They didn't protest taxes for 2 years. The previous owner, mm-hmm. based in California, visited the property once. And then we asked the property manager about raising rents. She's like, oh, it's really hard to raise rents during COVID. We haven't raised rents in a year. So we knew that was kind of a red flag. The returns were really, really good. And one of the reasons why we got a really deep retrade, we almost got $300,000 retrade after our money ran hard. Expenses just kind of bumped up by $60,000.
Retrade after the money went hard, huh?
Yeah, right after the money went hard, all of a sudden expenses went up. We're like, this is fraud. What is this? Mm-hmm. It was wacky. So, but the owner was very good about it. He was, he's like, look, we made a mistake, and we looked at the expenses with our property manager, Lindsay Haynes from Metric Property Management. Mm-hmm. She was recently on one of the podcasts with Mike Taravella. We realized that most of those expenses were not real expenses, and they're probably fraud. Basically we think the property manager might have been like embezzling money. Mm-hmm. So we figured that was a non-issue. It was a loan assumption, which allowed us to get a really good basis. And it was fixed rate, even though the rate was a little bit higher, 4.73, I think. It gave us comfort that it was fixed, and it allowed us probably get $10,000 per door lower than typical.
Nick, can I add a couple of things to what you're talking about real quick? What Nick's discussing is valuation through operation, not just renovation. And that's key in this part of the market cycle. We discussed that. You're not there just trying to turn units. If you can really work with the management play of this property, hey, that's a great value add right now. If you're reducing expenses, you're increasing NOI. That's really, really important. Why was this gentleman how did you find the deal? Was this off market? Was it a listed deal?
So it was a listed deal. We had a property that we got really close on, similar vintage, similar size in Garland, which is in DFW Metro. And the broker really liked how we transacted. We built a relationship through that. We weren't through that with that deal, but we were the first one to see the deal. Mm-hmm. We were first one to tour the deal, first one to make an offer. They didn't take it off market. But we always kind of had the inside track just based on that relationship that we built.
Speed of execution, really, really important. Let me just take this one question. If anyone wants to throw questions in the chat box, Nick's going to leave his contact information at the end. So you can even email Nick directly. But Jason asks, isn't Waco, Texas an oil gas market? I'm assuming there's got to be other jobs in that market as well now, correct?
So
Joanna Gaines is there. You got nothing to worry about, right?
Yeah. So the two big kind of like attractions to Waco is Baylor University. So my partner Mike, his wife works at Baylor as a professor. And now you have the Gaines, right? You have that whole thing. And a lot of tourists love going to the Magnolia, it's a big tourist thing. And it's brought a lot of business to Waco. About 10 minutes. So I would say, to answer the question specifically, oil and gas, a lot of Texas is oil and gas, but a lot of that is more of West Texas. Dallas is very diverse, and Waco is halfway between Austin and Dallas, so it's not really a driver of the economy.
Love that.
The loan assumption, you were kind of going relatively quick, and I want people to kind of settle in on that, because it's a big deal. Doing a loan assumption is not necessarily always the easiest. And you said the rate was 4.7%. Is that correct?
Yes.
So if you can make a deal work, and hey, look, 10 years running, it's dipping a little bit, but if you can make a deal work at 4.7%, when does that term, or I'm guessing there's yield maintenance, when does that start to burn off?
Yeah. So the yield maintenance, I think that we have like 7 years left or 8 years left on the property.
Did they have a 1030 and there was like full IO or full yield maintenance to the end of the term?
Yeah. Yeah, and it was 3 years IO, so
so they were into it
like
for
9
3
months.
years. Yeah, and they were so they're out quick then.
They were out quick. I think someone in the family passed away, and it was kind of a family ownership.
Yeah.
So this is more of a motivated seller. So that's the other thing with everyone's on this call. Make sure you're negotiating. It's always, seek first to understand, then to be understood. And really understand what's going on with this deal, understand why they're selling. Hey, they only bought it 2.5 years ago. Maybe they made some profit on this deal. Maybe they want to get out. Maybe there was a sickness in the family. Maybe they're motivated to sell. That's how we find deals in real estate, by sellers who are motivated. So it's really, really important to understand why they're selling. And that's why this is one way we can sort of tell where we're at pretty much, I don't want to say a high of the market, but as deals are being bought, when they're being traded within 18 months to 2 years and traded, we're getting at a high point. But from what I see here, the returns look great. I love
looks clean.
Yeah, I love the management play here. I really do like the market. I love the size, the 120 units.
Lower competition because of flat roofs, and it was a loan assumption too, so that created an opportunity.
And one other thing, Jake, that I love that he did, that we and you fell asleep at the wheel a few weeks ago and didn't tour a property and didn't put a deal. Speed of execution, my friend. That's what you need in this part of the cycle. You need to get off your butt.
What did we do wrong?
Well, there's a deal that was out there. We said, we're going to wait. We're going to tour it. And someone else came in, put an offer, got the deal because we never went out to tour it. It was our mistake. We made a mistake. We should have just put an offer in. But it's really, really important what you did here, because you need to be speed of execution.
I can't remember. Gino's mad at me.
I'm not mad at you. I'm mad at myself. I just remember Jake saying, we were actually waiting to go look at the property because we wanted to make sure the interiors weren't totally trash.
Oh, I know which one you're talking about. Yeah. We just showed on that one.
Okay. Right. So that's okay. I don't want to bring back any bad memories, but you learn from those mistakes. And that's why I'm here to tell everybody, when you find a decent asset and you really like it in this part of the market cycle, remember market cycle, debt, exit strategy, those are the three pillars. You really need to move quickly. That's why you have to understand your market. You have to know what the metrics are in the market. You have to understand your buy rate criteria. You put all that together and you move really, really quickly.
Yeah. Gino, go ahead.
Go ahead, man.
No, I was going to say, to speed of execution, I went down when I toured this property. I had a paper LOI, 2 paper LOIs, basically depending on what I found, right? I might kind of like lower the price a little bit if the tour didn't go well, but I gave him the LOI in hand and said, look, we take this property off the market. He didn't take it off the market. But
old school shit, man. Fill in the blank. This is what I do. I sign right on the dotted line. I like that.
That is excellent.
You're probably going to get to it. One other thing that you mentioned that I found very interesting was that the prior property manager was resistant to raise rents during COVID. And I think we all know that was just another one of those kind of made up COVID things that doesn't, obviously I'm sure you probably had a nice run,
even now.
Yeah.
Wow.
Is that fair to say?
Yeah, yeah. She had a little Post-it note on her monitor that kind of wrote in the rent card. Like that should be a
Yeah.
dynamic thing. But she wrote it in
Yeah.
and had it posted, and it just looked like an old Post-it note. And I was like, "When's the last time you updated that thing?" She's like, "It's been about a year."
Yeah. She probably
Jake,
likes to read novels and things. We run into those.
there's a question here that says XYZ. Is Z the multiple? I don't. This is the return line I am talking about. I don't understand what is X and Y. Do you understand what that question is?
Oh, I think it's maybe 13, 19, 1 point. So yeah, 13% is the cash on cash, 19% is the IRR, and 1.8 was the equity multiple.
Love that. Sorry about that. I didn't understand.
and
That's
and
great.
Chris, you're probably going to get to it. What was the price per door on this?
So it was just above 61 a door.
Oh yeah.
And you're gonna see the guy, he bought it, the previous owner bought it for almost the same price.
Interesting.
Wow.
So he lost, when he paid the broker fee, he lost money.
Yeah. So that's the thing. He's truly motivated. So I'm assuming that the
He bought
LTVs,
right. He probably, he financed a little high, but he probably was managing getting stolen.
I love that. That's right.
Yeah.
Buy right, finance right, but you didn't manage right. That wheel is moving. And that's what ends up happening. It's that $60,000 that they're stealing. You put that back on the NOI at a 5 or 6 cap. That's where the profit is. So the profit dissipated because it did not focus on the manager. I love that.
And you wait for the 25% inflation to hit before you get out. Sorry.
Yeah, would've
Anyways,
been nice.
carry on.
Next slide, my friend. Let it rip.
Okay. So this is just interior views, right? You can see the vinyl plank flooring. Most of the units look like this. And surprisingly, even the units that we toured, during due diligence, we looked at you have to look at every single unit, right? So we looked at every single unit. Lindsay had a little tool that allowed us to kind of record, like, the condition of the cabinets, every single piece of the unit. So we had that documented. But surprisingly, even the units that weren't renovated were still in really good shape.
Love that. This looks great.
Does.
So this is a little bit dated because it comes from our pitch deck for our investors, but these are the sales comps, and this is the most important sales comp. So this is our property, right? It was 61, a little bit above 61 a door. If we didn't have a yield maintenance like loan assumption, it probably maybe would have been 70, 75, right? We would have bought it. So it allowed us to get it a lower basis. But this is the most important comp here. This is when he bought the property in 2019, he bought it for 7.25. We bought it for 7.35. So with the broker fee, he lost money.
Wow.
So you look at the comps here, right? Gemini Village is on here. Tribeca, these properties now, this Gemini Village sold in March of 2021. It's on the market already, and it's on the market for 87. And Tribeca just sold. Lindsay's managing this for 88 a door. So the market, we bought this in September. We could potentially get our exit price now if we sold it, if we decide to sell it. Now we still have that yield maintenance, which is a big, it's like 1.5 million. So we have to kind of compensate for that. But the market is just like shot up, like a hockey stick, which
what are you guys gonna do?
We're still implementing our business plan. So, but we're thinking about, about it.
If
Nick,
anybody on here wants to float the right offer, we're not going to not look at it. I got you.
Nick, can I make a couple observations about this sales comp here?
Yeah.
Number one, you did a good job with the sales comp because the assets are 70 and 73. They're around the same amount of units, 120 versus 168. So you have really good comps. And I think the other thing is, like you just said, just to my point, Tribeca bought and sold again 18 months later. So it's really, we're still in that part of the cycle. I mean, that's what it is. When you're doing these deals, I think everybody on the call, the most important thing is try to focus on your exit strategy. Maybe when you're doing an assumption, you may not have that kind of wiggle room, but a deal like this one deal can set your whole team, free basically.
He whiffed on at least $3, the prior owner.
Yes,
probably at least $3 million.
Yes,
So.
$3 million. Yeah, he did. But I mean, this is something where it's a great decision to have. Hey, do we sell? Do not? This is something where you're going to add tremendous amount of value to this property, and this is going to be a cash monster. You're going to be crushing. It ain't going to be 13%. Once this thing is repositioned and you have your rents up to where they're supposed to be, this is going to be a really nice cash flowing deal. Superb.
And just one more thing, that this comp sandstone, it was kind of an outlier. We don't have rent comps here, but it was an outlier. We looked for some whatever reason, they were just getting much higher rents than a lot of the other comps. And then we dug deeper and we found that there was like a big private equity company that owned a ton of units across the country. So it was like owned by like, no offense, but it's probably some guys in New York, like private equity company really pushing rents. And we kind of knew that like, okay, if we were as aggressive as this sandstone, because the property is probably, it's better in some ways and not as good as in others, we could probably push really hard. And that's exactly what we're doing.
How are you guys managing your pricing and renewals? Are you using a Yield Star or are you doing it manually?
No, we're doing it manually. I mean,
but they may be using like a Yield Star or something that sets rents every day too. So it's like you just never know, right? Or they could be super aggressive. So
they could be. I mean, they have a lot of units. They definitely could be, but like we're actually, because I come from the institutional space, we do like rent surveys, and Greystar was one of my property managers. We're not even doing a rent survey anymore because we're like the highest rent in the market. So there's no reason.
So you're those guys from New York.
Exactly.
Love that.
Okay. So next step. So we are rebranding the property from Fleetwood Square to the Midway. And the Midway is the name of the school district. That's basically the better school district, and kind of like bring it back to New Yorkers. Like we put signs saying like we're in the Midway school district. Right across the street is a property called Azul. And it's in the not as good school district, the Waco school district. So we put signs there. It's basically kind of like a middle finger to the guys across the street. Like we're in the better school district. You're not, we can get better rents. And we're going to put a sign that kind of, enunciates that.
I thought it was like a Dallas Austin thing, but either way, I
love the sign. The sign is beautiful. I love the logo.
So this is awesome. A little tip. Our property manager showed that it's called logo. It's logo tournament or something. You go out there, like a bunch of people, you put information out there and they compete, So this costs us like, a few $100, this design.
Awesome.
Complete pool upgrades, right? So add sails for more shade for residents and upgrade furniture. Cable door fee. This isn't always a question that I ask. Do you guys have a cable contract? When does it expire? They had a not good bulk contract, $30,000 per year expense. They weren't billing back any of the free cable to tenants. It was terrible. And it expires. It was supposed to expire like in the summer. We terminated early for no cost. Now we converted it to rev share and we got an $18,000 door fee that we can distribute to our investors.
Bam.
So that was
awesome.
Huge. And the biggest piece is that $30,000 cost. I mean, it's huge. So we got rid of that.
I'm not looking to be a collections agency for a phone or internet company, and that's what they're looking to put it back on the landlords. And I want nothing to do with that. But
it's terrible. And then the biggest value add we had this property, and I kind of noted that we have very low capex, under $300,000. A little over $2,000 a door. But this is the biggest value add. Nick Amaluxon, a coach, he's done this in some of his properties. Just get rid of CSC. They're a terrible vendor, and buy our own, laundry machines and reap all the benefits. So that's kind of the bad, the biggest value add. And really, we've achieved 15, sometimes higher % above our underwriting in rents. We're one of the highest in the market because we're so aggressive. So we're cutting some of our CapEx projects. We just don't need to do some of these things to achieve the rents. And then that goes directly back to investors and pushes up the IRR for our investors.
Let's not pass over what you just said, because it's truly important in this part of the cycle. If you don't have to put in granite and you don't have to spend $7,000 a door to get a $150 rent bump, then don't do it. Maybe do it later on in the cycle if you have to. But if you're achieving rent growth without having to put a significant amount of CapEx, don't do it. I mean, it's just going to your bottom line. So really analyze the market and analyze where you can go. If you're going to spend $10,000 a door and get a $200 rent bump, but you spend nothing and you get a $100 rent bump, well, guess what? Don't spend any money, get that $100. That's basically where you are in this part of the cycle. Really, really excellent point you made.
I mean, I don't know if all markets are like this, but all the DFW brokers say, look, everyone's underwriting X per door in CapEx, but no one is putting $1 into their property and they're getting crazy rent bumps. So, probably
Mhm.
seeing that other parts of the market.
Yep. Love that.